Thank you, Pat, for that fantastic presentation. That was Patrick O'Meara, Inveniam CEO and Chairman. Joining Pat today for our final panel, coming live to you at the Global Investment Summit, is Justin Chang, Morris Chen, Scott Crowe, and our moderator, Brian Donahoe. Thanks a lot to all of you for joining us, and I'm excited for the panel. Over to you, Brian.
Great, thanks so much, Mike. I'm Brian Donahoe, and I'm excited to be joined today by my friends here on this esteemed panel. This has certainly been a tumultuous year in commercial real estate, and I hope the discussion today is similarly interesting. And we're going to work to cover many of the topics that have kept us busy this year and certainly looking forward as well. By way of background, I oversee the real estate debt business at Ares, based in New York. We focus on investments throughout the core plus, and opportunistic space in the private debt markets. And to start, I'll turn it over to Scott Crowe from Center Square to give a bit of background on himself.
Brian, thank you, and great to be joining everyone today on a Friday afternoon. Scott Crowe, Chief Investment Strategist, Center Square. Center Square is a $12 billion asset manager focused on real estate across 3 different lenses: private real estate debt, private real estate equity, and we're the 8th largest global REIT manager in the world.
Justin, how about you? You want to give a little of your background?
Sure. Thanks, Brian. Delighted to join today, and thanks for joining us. I'm a managing director and partner with Colony Capital. We're a publicly traded hybrid REIT and investment management company. We've been transitioning our business over the last several years out of our traditional commercial real estate investments into digital infrastructure, which I help lead, and we'll talk more about what we're seeing in the marketplace, hopefully through this panel.
Great, thank you. Morris, over to you.
Hi, everyone. My name is Morris. I oversee the CMBS and commercial real estate debt platform at DoubleLine Capital. We have about $12 billion in assets related to commercial real estate debt-oriented investments, and spanning anywhere from direct lending all the way to purchasing commercial mortgage-backed securities. So,
great. And last but not least, Pat.
Thanks so much. It's good to be with all of you guys. I'm the chairman and CEO of Inveniam, and we're focused on facilitating better data and better data transparency for on-demand, real-time access to data that can be credentialed on the performance of assets in a private market. So particularly in this new digital economy, focusing on how do we gain access to actionable data that can be trusted.
That's great. Well, Pat, maybe let's start with you. I think, look, all of our lives have been disrupted over the course of the past year by the virus, and certainly this industry we're going to talk on today as well. With respect to the work from home model that we're all experiencing and how it's disrupting the office market, what are your views, and what data are you seeing that supports this view?
Well, as the fundamental economic model that's used to value real estate is changing based on human behavior changing, right? That is going to sort itself out over 3 to 5 years. It's not going to sort itself out today. It's not going to sort itself out tomorrow, but you're seeing incredibly smart people. I'm going to use Justin as an example on this panel, whose firm made a bet about moving in a direction about where the economy is going with real estate. And it's clearly paying dividends. And what we're seeing is when significant owners of real estate assets want better access to data that they can see through to the underlying data, where they can get on-demand access to data that can be verified by alternative data sets. They need that in order to form the investment thesis, which was going to drive the investment decisions. And so the ability to have access to that data is paramount, and making sure that it's on demand and there's not 120 or 150 or 180 day lag is massive. And so that's what's driving a lot of the interest in Inveniam right now.
That totally makes sense. Hey, Scott, you've previously made the argument effectively not to bet against gateway cities like New York and San Fran over the long term. And hopefully I'm not putting words in your mouth, but and I think you've been focused more on multifamily, but what would you add to this topic about the long-term effects of work from home for these gateway cities?
But there's two things. I mean, look, it's a bad bet to make because if you look at the history of cities, I mean, what we're going through is a pimple. I mean, in 1967, the hot summer of 67, Manhattan burnt down from the East River to the Hudson in the Bronx. I mean, and we've had plagues and wars and other things. And what we know about cities is they come back. And they don't just come back, they come back actually relatively more important. And so why is that the case? Because it's a huge focal point of infrastructure. And that infrastructure allows density. And why does density matter? Density matters because it's exciting, it creates innovation, it facilitates communication. And what we're going through right now is just very adverse and very unique as it relates to the human experience, because density, COVID is the enemy of density right now. But I think there are definitely permanent things that are going to shift as a result of COVID. Don't get me wrong. And I think the office environment is something that we need to pay attention to. But as it relates to cities being alive, that's more than just the office market. Let me put it this way. The amount of firms that are headquartered in New York City today is probably the amount of firms that want to be headquartered in New York City today. But the amount of people that want to live in New York City versus the available stock of residential, that isn't a balance, okay? It's probably 2, 3, 5x. It just depends on price. And I'll tell you some real data that's coming out right now. For the month of October, we haven't got November yet, but for the month of October, applications for apartments in New York City were up 30% year on year. And what's the profile of those applications? Young people. They're taking a bite of the apple, pun intended, to get back into a city and enjoy it. And the fact is, we're going to get through the winter. Now, there are bigger ramifications as it relates to work from home. And some of this, I actually think, instead of fighting, we should embrace. It's actually an improvement in the way we work. We have been forced to use technologies like this call that were available to us for many years, but because of social norms, we didn't pick up and we weren't forced to use. And now we have been forced to use them. And what we figured out, it's more efficient in many instances. I hope I don't do every conference on a Zoom call, but I'm sure I'll do more. So if you look at the data, this is what it says. Average utilization of an office asset pre-COVID was 4.6 days a year. Today, it's probably closer to 1. Where's equilibrium? 3 to 4 days a week. All right, that equals a 15% demand shock to office. So where's that going to hit? It's not like every office asset's going to be 85% full. It's actually going to be concentrated in the lower quality stock. And that was a trend that was happening pre-COVID. And so is going to be something that accelerates post-COVID. You got to have a new building that has the amenities, safety, from a health standpoint now, and location that's going to not only retain and hire workers, but get them to come to the office.
Great points. I totally agree. I think your point about a city's ability to reinvent itself over time and this being another challenge, but one that's likely to be met, I totally agree with. And I think, your point about winners and losers in the office sector is absolutely correct. I think if you think about where developments are occurring in New York City and where tenants are moving, it's to the most technologically advanced buildings throughout the metro area. And so I think, like we're seeing throughout the economy today, that K-shaped recovery, I think, will apply to New York City office as well.
Hey, Brian, if I could add one thought on that, just to reinforce what Scott was saying, looking at the data, we were looking at 2 comparable buildings and their financials. One had about a 10% drop in income, and the other one was 100% generating income, no drop at all through COVID. But its foot traffic is at 3% of pre-COVID. Even though all the tenants are paying 100%, it's at 3% foot traffic. The one that had the 10% drop was at just over 60% foot traffic. I got to tell you, between me, I'd rather have the guy that I actually know what's happening to the lessees and I can rework that lease. Do you know what I mean? So those alternative data sets helping you value that data because that shakeout's happening, right?
Were they the same type of tenant, same industry group, out of curiosity?
They were Midtown New York City CRE assets.
Yeah, okay. Justin, Pat mentioned this, but your firm shifted rather dramatically into technology and digital-oriented investments over the past few years. Can you walk us through what the catalyst was for this and your view of relative value in that space compared to the traditional real estate assets we've all historically focused on?
Sure. Look, at Colony, our heritage really was around sort of opportunistic investing around commercial real estate, right? Equity, debt, up and down the capital stack, owning and operating assets where there was value coming originally out of the early 1990s S&L crisis, which is probably before many of those in the audience were born, albeit not those on the panel. And so that's kind of been our opportunistic heritage. And similarly, after the global financial crisis, we built a lot of assets around all the traditional multifamily, single family, retail, hospitality, office, industrial, et cetera. And we're sitting here in kind of 2016 and 17, really seeing our assets, in our view, priced pretty close to perfection. So the shift we made was really around value and opportunity. Obviously, we didn't foresee COVID or anything like that. Nobody did. But we began exiting some of the assets that we felt we bought well and stabilized, leased up, and were trading at really tight cap rates. And so we started selling into that at the same time that we, it's the old Wayne Gretzky, try to skate to where the puck's going to be in 10 years. And obviously, there'd been a lot of activity already in what people call digital infrastructure, data centers, wireless towers, fiber, et cetera. These businesses have their roots in real estate, hard asset. A lot of them are REITs, securitization, et cetera. So we made the decision to really pivot. And so we began exiting our traditional commercial real estate asset classes and redeploying that capital into digital infrastructure through an entity called Digital Colony Partners, which we formed and built an operating and investment team around that. And that was kind of early 2017. And today we managed about 45 billion AUM, of which about 25 billion is digital infrastructure. And I think by the end of 18 to 24 months from now, we'll be pretty close to 100% digital. And it's both the growth of that side of the business and the continued sell down of what we see on our traditional commercial real estate businesses. And for us, it wasn't any fundamental view other than for our capital, both our balance sheet and our limited partner capital on the fund side, looking at what they were interested in, what we were interested in, and just relative value and growth opportunity is what led us to digital infrastructure. Obviously this pandemic, I think for all of us has underscored the importance of the underlying assets, right, which support working from home, learning from home, telehealth, and all the other things we're all experiencing. And that's, I think, maybe accelerated some of these trends, and some of our businesses and underlying investments have benefited from that. But I think for us, it was really a long-term secular play over the next 5, 7 to 10 years. We see that opportunity. And again, not just here in North America, we've got a big business in Europe, Asia, Latin America, et cetera. So that's kind of what led us to that transition. And we're kind of, maybe half to 2/3 of the way through that, at Colony.
Got it. Morris, CMBS has typically housed more of the core food groups of real estate debt. And as public and private investment shies away from retail and at least temporarily hospitality in favor of these other asset classes, including what Justin's mentioning, what do you think that means for your CMBS book and future outlook for investments in the space?
Yeah, I think there's some important sort of takeaways in terms of differentiating, the difference between the CMBS that was created over the last 10 years and the CMBS that was created prior to the global financial crisis. And I would say that, the comprehension of lender control or lender conservativeness over the last 10 years, as a comparison relative to the global financial crisis, where where it was a lot looser lending standards that was going on, as well as rating agencies rating those transactions in a different manner with different models. I would say, like right now, the way the CMBS market is shaped up is it's going to be better than before, right? Like that's the initial sort of takeaway in terms of cum loss expectations, in terms of effects on bondholders in totality. Now, that's a fairly broad, generalized statement. One can kind of dig into a specific deal that's heavy in retail, that has a bunch of malls that are somewhat dilapidated or deteriorating. This pandemic has expedited that deterioration, and there are deals where there potentially will be impairments to bondholders, even at the investment grade rated tranches. And I think it is important to comprehend what you own as an investor. And for us, looking through these pools and looking through these transactions, and I mean, it's interesting seeing the comments, Justin, that you're making in terms of shifting to digital. Scott, the comments you're talking about with respect to trends in the big cities, as we're kind of applying that to CMBS in similar form and fashion, we as an investor, as well as the investor community, are also culling through what deals are exposed to inferior assets versus versus other deals. So it is a market where there's a lot of security selection. There's some deals that unfortunately has a lot more idiosyncratic risks that belies those transactions, and hence the pricing for this market is a lot wider, irrespective of what's going on in terms of the broader credit markets, right? We all know investment grade corporate bonds, as well as high yield, as well as the corporate credit market as a whole, has ratcheted back in a substantial manner. If you close your eyes, if you looked at your book in January and you close your eyes and you woke up today and you look at the spreads and pricing for credit markets, if you're in the corporate credit world, not much has changed. But with that said, March was a big event that you slept through, and I would say CMBS and parts of the real estate debt markets, a lot has changed, and that's a somewhat of a telling sign. So that's my view, how we're looking at our book. A lot of security selection to be had, and I would say expressing views right now, it's an ongoing process, right?
Yeah, it's interesting. We talked about it earlier this week, but the amount of liquidity that was poured into the corporate credit market and the compression in yields there to kind of historic tights makes private real estate debt look really attractive on a relative basis. But I think the points you raise about asset selection are certainly true. And I think, turning back to Patrick, I mean, the intention of your firm, as we understand it, is to really add value to each of the business lines of the other panelists and a lot of real estate investors generally. But it's also been it's been a relationship business historically, and data, the information that people have was always coveted and held close to the vest by various individuals in the deal chain. How are you working to change this, and what's the specific value proposition you're making to potential clients?
Yeah, the value proposition changes for different organizations, but the ability for us to use our software to credential data in its place of rest, push it to somebody like a Cushman & Wakefield who can start pricing an asset monthly, right? It becomes a USPAP compliant price monthly, FREA compliant price quarterly, moving that asset from level 3 to level 2, just like commercial high yield bonds did in the 2000, when those went from 3 to 2 because of the work done by the pensions. That exploded the amount of money in high yield bonds, and then they're trading differently. Real estate, the same thing's going to happen, is we actually have the ability to move a real estate asset from level 3 to level 2. What does this mean for an insurance company? Well, an insurance company, they can move a real estate asset that they own in Schedule BA, which has a 20% capital reserve, to Schedule A, which is at 10%. There's huge capital optimization opportunities because they're getting better data. And we think value-added real estate in the future is going to not be new countertops and paint. It's going to be taking a dumb building, making it smart so that you can have real-time data to feed those models to get the comps in order to move the asset from 3 to 2. Once that happens, also for banks, that changes their tier 2 capital. It changes their capital risk calculation, their value risk calculation. It's really transformative to the markets. And this data asymmetry that has happened in the markets is going to go away as you have better data, as you have real-time pricing of assets, and you're able to see in the real estate trade where you have right now a bid and an ask, and that bid is conditioned on 120 days of due diligence. When you've got KPIs on that building that you can compare that asset with data that you can trust against 50 KPIs on buildings that you own in your own portfolio, you're going to be able to stipulate performance of the asset data and focus on bid ask. And you're going to see buildings closing in 2 weeks, then down to 5 days, then down to 2 days instead of a 120-day bid. And that's all based on better data that's fully observable. And you're going to start to see this liquidity trickle. And I think what Scott said, where he was talking about that 15% delta in use of an office building, and again, piggybacking on then what Morris said, that 15% isn't going to take a haircut across the entire market. It's going to impact some managers massively, and other managers are going to skate unscathed, right? Because it's about asset selection and real assets and getting real-time access to data, how those trade, and really the digitization of performance data. So just like you get audited financials, you're going to get audited asset performance data that is going to be more important than the audited financial data, because then you really know the performance of your asset. And so that will affect the security selection of Morris. That will affect Scott as he invests in different cities, and Justin as literally the amount of data that's being created is exploding, and how people own it, how they manage it, and how they credential that data is it's going to be a new world soon.
It's super interesting. One follow-on question, if I could, not to pick on you, but when this disintermediation occurs, there's usually a loser, right? So who loses out in the traditional real estate business as you grow this footprint and that data becomes more accessible?
I think that people who've made their livings doing information arb, in a local geography, are going to have to start to utilize data more efficiently. And we're going to see market, instead of asset versus asset selection, one market trade, Des Moines trading off of Kansas City, or Copenhagen's trading off of Edinburgh. And you're going to see people having better data. They're going to move, and that's going to move liquidity. And these large real estate yields, we're going to see that illiquidity compression in the private markets to more closely match public as data gets better and more efficient.
Right. So kind of the real-time movements of the public equity market will be reflected in quasi-real-time movements in the private market.
Well, Brian and Scott, I think the losers are, look, if there's a loser here, it's the real estate investment manager. I mean, we make our living out of the inefficiencies of information. I mean, you said it before. How many deals have you seen come to market that it's not like you put a trade on a screen? I mean, we invest in real estate both through the private markets and the public markets. I put a trade on the screen to buy Boston properties. The whole world sees that, right? You sell an office building in New York, does the whole world see that? No. Why? Because it's a heterogeneous asset that doesn't have a lot of data attached to it. So I think there's an upside here, which is that, as Pat was saying, I think what you'll probably see is that the risk-adjusted return of real estate will fall as you have more capital available to invest in it. But, at the same time, I mean, and look, I don't want to overstate how quickly this is going to happen. I mean, Pat, I sort of laud your approach and what you guys are doing, but it's a big elephant to consume. It's going to take some time, but at the end of the day, if we really move to a world where everything is digitized and there's true price transparency, then real estate is a very efficient asset class. And just like we've seen in the equity markets, all the alpha gets squeezed out.
Scott, I'm talking about that timing and how long it's going to take. I agree completely, right? We've been working at this 4.5 years. We're there, but we're seeing this tipping where the largest of the large pension funds, the large asset owners, they want this data from their GPs. They want asset by asset third-party marks from their GPs. And let me tell you, when those guys say I'm in, I was talking to somebody earlier this morning. They have 100 billion in private equity. That those are just big numbers, and they want third-party marks for everything that's non-VC. And digitizing those on a real asset side, it's going to move. And once it hits the tipping point, I liken this to when I was at Bear Stearns, and we went from fractionalized to decimal, decimals, and all sorts of people were saying, oh, well, the value of the fractions, right? It helps us, right? Forget it. All we were trying to do was protect the commissions. Do you know what I mean? Protect the spread. And when decimalization happened, it exploded the market, right? Some people died, some people thrived, volume went through the roof. We're going to see volume go through the roof in real estate. We're going to see assets being held for a lot shorter time. We're going to see liquidity, and we're going to see movement in the market. But yeah, there will be people who die in this.
Yeah, totally makes sense.
Business-wise, not COVID-wise. Sorry.
Okay, it totally
businesses will go under.
Information flows are going to be important to what we do. I don't know that you ever fully remove the subjectivity, right? Real estate won't be a paint by numbers industry, thank God. But I think that information flow is really exciting for what we do day to day. We started to touch on this, but let's just continue down the path of relative value in our collective space. I think crises like what we've experienced have historically led to great differentiation in credit quality being reflected in the capital markets. And Morris, I'll turn to you, but within DoubleLine's fixed income portfolio and as it relates to real estate, where are you seeing the best value in the public and private markets today, and what does that look like?
Yeah, I would say, we'll start off with private markets. I think within private markets, there's definitely this awkward period where lenders are slowly warming up to real estate. In March, they were not. They were definitely, held their cards close to their chest with respect to what their intention is to do. Essentially, a tighter, more restricted lending environment. And I would say, like, at this juncture, there's definitely a lot of deals to be done as a lender in this environment because of that of the market dislocation, right? Like, there's that illiquidity or private market sort of premium that is there relative to public markets. You're definitively, as a lender, if you have capital, if you want to go out and lend against, maybe assets that, I'll use retail or hospitality by way of example. There's definitely deals to be done to the extent that you do your homework appropriately. In similar form and fashion, as we're kind of moving away from private markets into more of the securitized markets where you can actually go buy prepackaged securities from Wall Street. There's definitely a K-shaped sort of recovery, the haves and the have-nots, as it relates to relative value and how we're thinking about the world. The right now is largely centered around picking and finding securities and investments that we feel are appropriately protected from losses. And as we're thinking about that, that's somewhat of a generalized statement or an obvious statement. But as we're thinking about this market, from my seat, my number one difficulty as we're assessing credit risks, given that we are ultimately a debt investor and our returns are essentially capped at what the coupon is going to be paid is going to be paying us, or what the purchase price we ended up buying those securities. It's important the difficulty is extrapolating what is that stabilized view. Like what is this office asset going to stabilize into in an environment that is, 2 years out, 3 years out, 4 years out, 5 years out, or 10 years out? And that, notion that we're discussing here about buildings being able to survive and buildings that aren't going to be able to survive within an office market, I truly believe that is, these are, the early stages, at least from an investor sort of perspective, as you put into your repertoire of credit assessments, adding that sort of qualitative view to your investment analysis. So that relative value, the difficulty of extrapolating the stabilized viewpoint tends to make me, as an investor, want to invest in bonds that I feel are adequately protected. So you want to buy up in the capital structure. Relative to the dislocation, spreads are still wide pre-COVID or pre-pandemic levels, and there's definitely investments to be had. And if you want to compare that again to other spread products, there's definitely a lot of room for improvement within the CMBS market as a whole to find investments that allows that sort of total return. So we are canvassing the market in essence, where I would say a lot of the investors are doing the same thing. And CMBS is what I would call the institutional investors sort of way of buying into the vaccine recovery. Just because of the dislocation that's going on the pricing. So in similar form and fashion, people are pumping up public equities, whether it's REITs over the last month. On a month-over-month basis, a lot of the REITs are up 30%. In similar form and fashion, on the CMBS side, you want to express a view on hotel, buy a bond that has a lot of hotels, or buy a bond that has a lot of retail. And that's definitely a unique area within the market that you can bet on real estate.
Yeah, it totally makes sense. I think it's the compression in yields that we've seen in the public markets, especially. I think what we're seeing in Ares is the opportunity to lend in the private markets and finance those loans in the public is a pretty significant arb today. Given, and I think, Pat, this speaks a little bit to where your focus is, right? The information flows are just slower, and so that arb exists today. Scott, how about you? What's your focus going into 2021? How are you playing the relative value in the space today?
Well, it's interesting because if you look at the equity markets today, they're all-time highs, but I believe there's a lot of opportunities still left available in the REIT market. And we came into 2020 fairly well positioned. We were overweight cell towers, data centers, industrial warehouse distribution, single-family rental, life sciences, cold storage, all the things that have actually performed very well through COVID. We were overweight these sectors because we saw the big secular demand behind their fundamentals. But starting about the summer, and we weren't, we could have been earlier. I mean, March was the time to buy these investments. But coming into the summer, what we recognized that the valuation band between the haves and have-nots had spread so far, it was really behooved us to go and try and find some value. And I think it's sort of Morris was discussing the big challenge we have as investors is that, look, we know interest rates are low. Okay, we know we're in a yield-starved environment, but what is the stabilized NOI we can underwrite? And if you have I think what the market's probably underappreciating on the real estate side and the REIT side is that if you have a stabilized NOI, even at a reduced level, that is flat to growing, that is essentially a bond that should be aggressively repriced in the positive in terms of cap rates coming down and yields compressing. So where do we want to attack value right now? Okay, so I'll tell you what we've been doing. We've been selling the winners. We've been selling the industrial. We've been selling the life science, selling the data centers, cell towers. And we've been buying shopping centers and apartments in gateway cities. Office, we're punting on. I'm not sure how that's going to play out. I think it's going to be a lagged recovery. But again, back to my point earlier, you're already seeing people coming back into places like New York and San Fran as prices drop. And if you look at the REIT equity markets today, they're pricing in a about a 20% decline in commercial real estate values for those apartment assets. And I think that at the end of the day, in 2 years' time, I mean, I would be surprised if it was anything less than 0% decline from where marks were at the end of last year.
Yeah, that totally makes sense. Justin, look, you've worn a lot of hats over various cycles, as you said at the outset, and played in a lot of different geographies. How do you compare this crisis to prior financial events in your career? And I'd add to that just what the government reaction, how different it is to the RTC, as you mentioned, or the GFC.
Yeah, look, I'm not sure I have any differential insight on that question because it's, it's something we all pay attention to. Look, the government response this time around has been incredible, right? The Fed's been flawless. I think flawless is too strong. The Fed has really reacted well. They reacted well in 08, and this time, whatever they didn't get right in 08, they moved early and aggressively and often. For a moment in time, we had bipartisan consensus in Washington to move quickly. It appears our politicians are kind of bumbling their way to getting something done this month, which is good. But I think the governmental response, both here and around the world, has generally been quite strong, notwithstanding the overall political stuff. I think we learn from each crisis, right? Each one is similar, but they're a little different. I think the markets, as we all know, are clearly anticipating a recovery, and I think the markets are right to do so, generally speaking. The relative value question that you ask is the core question. And I think it also has a lot to do with your investment horizon. We made the judgment, I guess it's a relative value judgment 3 years ago, based on secular trends to redeploy our capital. And I think on this panel, I'm probably a longer term investor. We're probably medium term private equity style investors, 5 years, give or take. So we have a slightly different horizon to how we look at that relative value. But I think versus other crises create opportunity. And while we hate to talk about opportunity in the middle of, the pandemic, from a human standpoint, clearly there'll be winners and losers coming out of this. And I think whether it's asset quality, whether it's gateway cities, and I agree with Scott. I think New York will reinvent itself as it's done. London will reinvent itself. San Francisco is reinventing itself, et cetera. And I think those cities will come back bigger and better, differently, and there'll be a lot of shakeout in between. And that's opportunity for those of us on the phone and in the audience. And I think that transition is where you can still find inefficiency, right, Patrick? As data gets better, and I think we all benefit, but those of us who get paid to do this, we need to stay a little bit ahead of that, right? And I think it's in these transitions, these dislocations, these sort of intervening unforeseen events like this pandemic, which creates the opportunity to drive alpha. And for all of us in this business, we've got to be able to do that. Otherwise, we shouldn't be getting paid to do this, right? So I think the information flow is getting more efficient is great for everybody. But I think these dislocations are what really create opportunity, just as the financial crisis or the Asian financial crisis or the tech bust or the RTC crisis created a lot of winners and a lot of people who were market leaders that you don't hear about anymore. So I think this is that kind of opportunity. And, look, we're excited about the road ahead. As I sense that excitement on this panel, and I share that view.
One thing you touch on is the knowledge and the learning that we've all gotten from prior crises. The unique part of this is that we're not in the office sharing it. And I'll open this up to anybody, but is there going to be a lost generation of learning from this crisis and that we're not all in there together seeing the day-to-day?
It's a good question. I'll just give my quick answer. I think what we've tried to do at our firm, and I don't pretend to have it all figured out, I think we're all experiencing the fact that at least for a while, we feel more efficient. We've tried not to be overly bureaucratic, but we've probably got more regular partners calls, investment committee calls, firm-wide calls on Zoom or Teams. And a big part of that is just making sure we're exchanging that information real time and trying to replicate the the morning coffee or water cooler stuff you get from popping into people's offices. It's not perfect. I find that because none of us are flying around on airplanes, which we normally are, which is a massive loss of opportunity to have those information flows. In some ways, I think we've been able to keep up maybe even better. It's probably not sustainable, but I think we've been able to keep up a little bit better, and it's doing a lot of this kind of stuff, right? With our internal colleagues, with our partners, with our shareholders, with our CEOs of our portfolio companies, with our customers, and with our competitors too, right? Who sometimes we're partners, sometimes we're competitors. And so I think in a way we've been able to be more efficient and responsive. But again, how that looks over time, I'm not entirely sure.
Look, I completely agree, Justin. Look, there's been some really good things that have come out of COVID, right? And maybe that's not a popular statement to make, but one of them is the fact that we've utilized technology that's been available and we've become more efficient. But it's easy for us as people on the phone who are on the computer with gray hair or less hair and who are older, who have been through cycles before. And it's another thing for the younger people in our company, because a year that passes for myself or other people on the panel, it's another year. You think about the formative years you had as an analyst coming up in a company. Like, every year matters so much, and the information that can get passed around and grabbing someone and bringing them into a meeting or having that conversation in the corridor, there will be a gap, Brian. There will be a gap. There's definitely, for whether it's my 5-year-old children who are not learning as well as they should, through to the to the analyst that's 23 years old who just joined a firm and their entire experience has been remote. Yeah, there'll be a gap, and that's a cost. That's a cost of COVID. It's beyond the human cost. But it's something we'll catch up on. I think the longer term ramifications are actually, and to talk sort of Justin's business, I mean, we're big believers in the infrastructure that creates the new world. I don't think that there is a switch that turns on when we come back with a vaccine in the summer of next year that takes us back to December 2019. That's nostalgic. Right? The world has changed, and it's changed permanently. There's been a cost to that. There's been a human life cost. There's been, politics, social unrest. But it, like any crisis, there's something that comes out of it. And the big thing is the utilization of technology to make our lives more efficient.
I want to add to that. I think that the evolution of our industry, the evolution of our businesses, the evolution of our civil societies coming out of this, we see that. I do think that there is a devolution, where you see, not necessarily from a learning, but this human impact. And I see this of my younger employees who are not plugged in with kids and a spouse and a whatever, right? That loneliness, right? That which is real, and the human skills matter. The data, we're getting more efficient with data. We're getting more efficient with this, but I will tell you, it is interesting managing this. We're a small company, right? 60 employees. We're a startup, whatever. But the reality is my mid-sized, my mid-level, non-married, those are the people I worried about the most. You know what I mean? Like, we got to check in on them. We got to make sure they're doing well. We got to do that. And so that is, I think, positive, taking care of people the right way. You know what I mean? From a business perspective. But I think the negative is there's mentoring that people are missing, of being around in meetings. How do you handle things, et cetera? There's a gap there right now that I think is interesting, as I forget if it was Justin or Scott who said, that 23-year-old analyst, that this is their first job. Boy, that's a shock,
Totally.
Yeah.
Totally. And I think you see it in the amount of people showing their face on Zoom screens. It's usually weighted what we're hearing to the older demographic, as you said, those with the grayer hair or less of it. And I do think that mentorship takes a little bit more affirmative rather than passive action, right? Justin, to your point, the water cooler discussion just isn't there. You're not grabbing coffee or beer. Just pivoting slightly to a topic that I'm sure we've all spent some time on, but at Ares, we've been pretty focused on ESG for the better part of the last decade, and it's been an important part of what we do. And certainly that's becoming more so over the last 2-3 years. Morris, can I just ask you to weigh in as to how ESG is impacting what you're doing at DoubleLine, both from a HR and kind of corporate responsibility perspective, as well as how you think it weighs in on investments? And Pat, I'd love to hear your views as well.
Yeah, I mean, it's definitely something that we've been continue to organically evolve into and take the matter in a very, very serious manner. I would say, within the halls of DoubleLine, as well as even, factoring in investments, factoring in our clients' needs with respect to that are mindful of ESG. It is within the top of our agenda as we're thinking about continuing to be a institutional manager, institutional leader within the investment management space. So, as it relates to how it impacts us, definitively we do have, we are very mindful of these, and we have, set up and, internal processes to be cognizant of this and continue to grow in this area. Away from that, I would say, it is something that's important to us. So.
And Pat, are you seeing ESG in the data that you're working with? Maybe it's specific to environmental to start with, but does that come into play?
Well, we're doing a really cool pilot for some of these green bonds, right? Where with it used to be people just wanted to see what was the use of proceeds. Okay, how are you going to spend the money? But now people who are owning these are saying, well, is the building more efficient, right? Are you using less water, right? What are the outputs of the building? And they want to see measurement, and that's being built into that. So we're doing some of this reporting, real-time reporting from those assets on a green standard, on a green measurement, where it's not just where there's some type of objectivity, you know what I mean? And there's some type of intellectual rigor. And it actually really is cool where you're actually able to see this, but we're moving away from where's a good intention that I'm gonna monetize to get a project funded, to I'm actually going to implement in something that is more efficient, it uses less energy, etc.
Yeah, makes sense. And I see Merrick's rejoined, so I know the Oscar music is going to start playing soon for us. But look, we've talked a lot about macro and micro trends we're all experiencing, and also just analytics changing the way we invest, the transparency coming into the market, kind of under the auspices of reducing the surprises that we all experience in our investment universe. But if we look forward 12 months, what are the things that, and I'll open it up to anybody, but are not priced in the market? Where are the surprises out there to the upside or downside? Scott, maybe
I'll go first. So I think don't bet against global cities. They're going to come back. Frankly, you don't need to believe they're going to go all the way back to 2019 to believe they're good value today, particularly in places like the REIT market. But do not underestimate the long-term consequences of a crisis. You go back to the global financial crisis of 2007, we were left with some very long-term trends in the real estate market. One of them was e-commerce. One of them was a move to a renter nation. What's going to happen after COVID? Office is going to be less valuable, and it's going to be bifurcated. And that's where the institutional world is going to be most surprised, because everyone got the joke on retail coming into COVID, but the average institution has 25% of their assets in office, and they thought of that as a bond. And that's not the case in the future.
Makes sense. Justin, anything you want to add there?
Look, with Scott, I'd say don't bet against big cities. I'd say don't bet against America, right? It's popular to talk about, and we certainly have no shortage of challenges in the country, but people ask me this all the time. Our business is very international. And one thing I always say is when I go around the world and talk to people in Asia or Europe or Latin America or the Middle East, there's two things they have in common, right? One, they want to get their kids to the US to go to school or college or grad school. And second, they want to move their money here. And that has not changed in this crisis. So, I think we'll come back better, different, pros and cons for sure, but I wouldn't bet against America. And the surprises for me, I think, are largely going to be around the political and kind of non-economic realm, I think, as we look at it. And I think political risk everywhere has gone up. I think this crisis has accentuated some of the profound differences in not just our country, but other places, inequality, et cetera. And, I think, it's humbling. We can all keep doing our jobs sitting here and market's high. If you own stocks, you're doing great. If you own real estate, you're doing great. We can all do our jobs sitting here, and many people can. And so I think those political and social tensions coming out of this need to be addressed around the world. And I think we're just beginning to grapple with that. So to me, surprises that could affect our businesses or our asset classes really revolve around those kinds of topics, I think, in the years ahead.
Makes sense.
Yeah, I would add, if I could chime in on this. I mean, I would say, we often, as a macro, if you look at the macro economy and look at equities, the market is hot, right? And have jobs, we're all working, but there is, however way you want to describe that, and at the end of the day, there's a lot of pain that's underlying that, and the permanent effects of that is going to be, I would say, Scott, you kind of commented it earlier, but there is, just because there's a vaccine doesn't mean we're going to return back to December 2019 immediately. And I think that surprise, the way the market's shaping up, I feel like that's going to be a surprise. So.
If I could add one word to this, and I know, Merrick, I'm taking it long, I would say in 12 months, the biggest impact we're going to see is the way financial regulation transformed the financial industry when you decommissioned or deregulated commissions, the set commission schedules, and allowed market pricing and the volume increase in the trades. The real estate industry has not been regulated as a constraint of growth. Rather, what's happened is constraint of growth has been around good access to data to act efficiently and quickly, right? And as data increases, you're going to see the same levels of consolidation, movement, expedited trading in real estate that you saw happening in the financial services industry, moving from pits to electronic, et cetera. And I think the whole market's not going to be transformed in a year, but in 12 months, we're going to see the first glimmers of where real estate's trading 10 years from now, which looks a whole lot more like, the Merck and the New York Stock Exchange than it does a title company in Naples, Florida right now. You know what I mean?
Totally. Well, look, this has been great. I want to thank each of the panelists. I certainly enjoyed it, and I hope everyone else did as well. And I certainly learned a lot. So hopefully more to come. And thanks for taking the time.
Thanks, Brian. Thanks, everyone.
Thank you. All the best.
Thanks, everyone.
Thanks, guys.
Thank you, Brian. And a big thank you to Scott, Justin, Morris, and Pat for delivering such an engaging panel to close out the summit. As we end the show, I wanted to take this moment to thank our sponsors once again. Fidelity Digital Assets, Data Yes, Backstop Solutions, IDB Invest, Boston Consulting Group, Moody's Analytics, Invest Northern Ireland, and Inveniam, whom you just heard from. I really hope you've enjoyed the last 2 days. And on behalf of Reuters Events, I want to thank you for attending. And I hope that we truly were able to help you improve your investment strategy for 2021 during this 2-day summit. Thank you very much. My name is Marek Razuk, and I appreciate all of your time. I will see you soon. Thank you very much.